Picture this for a moment. You finally get a raise, maybe a promotion, more money in your bank account. For a brief second, it feels like progress. Then reality creeps in. Rent increases again. Groceries cost noticeably more. Fuel prices fluctuate every few weeks. Eating out suddenly feels expensive. You're technically earning more, but somehow, it doesn't feel that way. Now look at the other side. Stock markets trend upward over time. Property values keep climbing. Asset owners seem to get wealthier quietly. So here's the uncomfortable question. If inflation makes life expensive for everyone, why does it often make wealthy people even wealthier? The answer isn't simple, but once you understand it, you start seeing the financial world differently and possibly planning differently too. Inflation is often explained simply as rising prices. That's true, but incomplete. Inflation is really about purchasing power declining. Your money buys less than before. Historically, inflation has existed for centuries. Ancient empires diluted coins. Governments printed money during wars. Modern economies use monetary expansion during crises. It's not new, but what has changed is how deeply inflation shapes wealth distribution. Because money doesn't enter the economy evenly. It flows through specific channels first, and that's where the imbalance begins. When central banks increase money supply, they rarely hand cash directly to everyone equally. Instead, money often flows through financial institutions, large businesses, investment markets, credit systems. This means the first recipients are usually investors, corporations, asset holders, not average salary earners. By the time inflation reaches wages, asset prices may have already risen. Stocks climb. Real estate appreciates. Businesses expand valuations. This timing difference creates advantage. Economists sometimes call it a distribution effect. In simple terms, those closest to new money benefit first, and those further away react later. Now let's talk about assets specifically. Assets include things like stocks, property, businesses, commodities, intellectual property. When money supply increases, these assets often rise faster than consumer wages. Why? Because excess liquidity seeks investment opportunities. More money chasing limited assets equals higher prices. If you already own assets, inflation can increase your net worth passively. If you don't own them yet, entry becomes harder. This explains why younger generations sometimes struggle. Higher nominal salaries, but even higher asset prices. It's not laziness. Often it's structural economics. This next mechanism is powerful and often misunderstood. Debt. Most people view debt negatively, and reckless debt absolutely causes problems. But strategic debt can work differently. Wealthy individuals often borrow to buy assets, property investments, businesses, portfolio expansion. Here's where inflation helps them. Inflation reduces the real value of fixed debt. Imagine borrowing a large amount today. Over time, inflation rises. Currency purchasing power drops. That original debt becomes easier to repay in real terms. Meanwhile, assets purchased with that debt may appreciate. So debt shrinks in real value. Assets grow in nominal value. That's leverage working with inflation. Middle-class debt often funds consumption, cars, credit cards, lifestyle expenses. Wealthy debt often funds assets. That difference compounds over years. Another key factor is how income is generated. Most people rely primarily on wages. Salary increases tend to lag inflation. Negotiations take time. Promotions aren't constant. Job markets fluctuate. But asset-based income behaves differently. Dividends adjust with corporate earnings. Rental income often rises with inflation. Business profits may increase alongside price levels, so asset holders have more adaptive income streams, while wage earners play catch-up. This creates a gradual but persistent gap, not overnight, but steadily. Everything intensifies when inflation spikes. History shows repeated cycles, economic shocks, monetary expansion, inflation surges, policy tightening. During these phases, interest rates rise, borrowing costs increase, consumer confidence drops. Average households feel immediate pressure. Food costs, energy bills, housing affordability, daily survival becomes the focus. Investing often pauses, but experienced investors behave differently. They reposition portfolios, shift asset allocation, look for undervalued opportunities. Economic turbulence often creates discounted assets. This accelerates wealth concentration, again, not always intentionally, but structurally. Today, inflation interacts with several modern factors: globalization, housing shortages, technology disruption, financial market accessibility. Housing affordability is a clear example. Property prices rise faster than wages in many regions. Ownership becomes delayed. Delayed ownership means missing appreciation cycles. Stock markets show similar patterns. Long-term investors benefit disproportionately. Late entrants face higher valuations. This creates generational financial tension. Young earners aren't necessarily poorer, but asset ownership timing differs. Timing matters enormously. Inflation doesn't just change numbers, it changes behavior. Uncertainty increases risk aversion. People prioritize safety, cash savings, low-risk choices, deferred investing. Ironically, prolonged cash holding during inflation erodes value. Meanwhile, disciplined investors maintain long-term perspective. Emotional reactions often determine financial outcomes. Fear delays decisions. Delay increases opportunity cost. Understanding inflation psychologically is almost as important as understanding it economically. Inflation isn't purely negative, nor purely beneficial. It's a force, a financial environment, and environments reward certain behaviors. Historically, asset ownership tends to outperform cash holding during inflation. Financial literacy reduces vulnerability. Early investing increases resilience. Waiting rarely improves positioning. Time remains the strongest compounding factor. Not income alone, not luck alone. Time plus informed action. This isn't about becoming extremely wealthy overnight. It's about positioning intelligently. Small, consistent actions matter. Understanding money flow, starting investments earlier, avoiding purely consumptive debt, diversifying assets gradually. Financial awareness isn't elitist anymore. It's protective. It reduces stress. It expands options. And options create freedom. That's ultimately what most people want. Not just money, flexibility, security, choice. So here's something worth reflecting on. When inflation rises, are you mostly reacting to higher prices? Or are you positioned to benefit from the system behind them? Be honest with yourself. And if you want, share your thoughts. Because awareness today can shape financial reality tomorrow.